All right, team. So this podcast is actually a recent webinar that we did with a Kiwi-based company for free of charge. Now, if you would like us to come into your workplace and talk about financial well-being, reach out via the link below. And remember that this podcast is actually best viewed on video.
So for those who don't know us, my name is James Blair, financial advisor, joined by
Matthew Horncastle, property developer.
Michael Vincent, I'm a mortgage broker. So, we've really got the full spread here. You get the plan, you get the money, you get the house. It's not a bad shout.
Yeah,
Other property people on this side.
Yeah.
And I want some conflict tonight, gentlemen.
You've got it, mate. Don't worry. At some point, we do a property versus shares slide, and this end of the table is very heavily weighted to property, as you can probably imagine. James claims to be Switzerland, but mate, I've seen your slides on the S&P.
It's really the personal wealth allocation is where it speaks.
Yeah.
And even people that say they buy shares, they normally have more money in property.
Oh yeah, 100%.
Very interesting time to be doing this presentation. Obviously, with the inflation number coming out just last week, we had Jared Kerr, the chief Kiwi Bank economist, join our podcast last week, feeling far more bullish about, will we see an interest rate cut this in August?
Yes, my pick is end of the year. And I'm going to say it. It's recorded. I'll say it anyway. My pick is cut in the last rate review of the year, and it's 0.5.
Or 50 basis points.
Yeah, I reckon that'll be
off the bat.
Yeah, I reckon that'll be 50 basis points. I personally think the lag in the data is too long. They will realize that actually the foot has been on the throat of the New Zealand economy for too long, and they'll know they will have to cut quick. Yeah,
I definitely agree with cutting quick.
Tonight's an interesting one. The first time Lighthouse and Williams Corporation have done a joint webinar together.
It is.
So it'll be a lot of fun. Today is all about how to build your financial plan. And funnily enough, we'll be talking quite a bit about property in that as well.
Macroeconomics.
Yeah. So tonight is really, I'm a financial advisor. We're giving away all the secrets. You can come and talk to us afterwards because we know we give away all the secrets. Some people still want some help. But tonight is really talking to you about how you can get ahead. So tonight we're going to talk about financial planning. Matt's going to talk a lot about the property side, and then we're going to do the Q&A at the end. So we're going to talk for maybe like 45 minutes, somewhere around there, and then do the Q&A at the end. Pop in questions as you go. Try your best to use the Q&A instead of the chat, just so we don't miss anything. And the Q&A is a lot of fun at the end.
Yeah, 100%.
Sweet. Let's jump into it.
Cool. So here at Lighthouse, we have a pretty simple action statement, and this is our mission, right? It's to secure Kiwi's financial future. And it's a pretty basic equation. Education plus action. And you're going to hear us talk a lot tonight about taking action, because to be honest, if all you had to do was sit down and listen to us rattle on for an hour and you got right to the financial freedom, that would be easy, but that's not it. There's a little bit of time sprinkled in there as well. This doesn't happen overnight. If someone's telling you a get-rich-quick scheme, it is probably bullshit. Education, action, time, financial freedom. Cool. So this is a bit of our vanity slide. So we've got about 4,000 clients across New Zealand and growing. We've settled 900 properties and we have 50 million of funds under management. That is definitely James's side of the equation. I am more on the properties.
Right, he's sold us a little bit short there as well.
Yeah, he has. Okay. Cool. And then something that we do have to point out here is on this webinar, we are just giving you general information and talking in general terms. This is not personalized financial advice. We love the Q&A section, right? Like it's our favorite bit. But if you get down to it and you go, Mike, guys, I'm 30, my partner's 32, I earn X, they earn Y. What fund should I be in? Should I be in this, or property? That is personalized advice. We just can't do that in this forum. We don't know enough about it. I will come very close to giving you personalized financial advice, but I will say that it's not, kind of as I'm doing it. So but honestly,
will give.
Yeah. No, I won't. But honestly, if it does get down to that level when you're asking us personal questions, we will just say, hey, look, booking a time to come speak with us. There'll be some links in the chat and at the end of the presentation as well.
Cool. Okay. So this is the blueprint. So if you take nothing out of today's presentation, this is how we get ahead in life. So we're going to talk about the high level and then break it down through the rest of the presentation. The big thing with money, and gentlemen, hopefully you agree with me, people make stuff too complicated. Yeah. We love engineers. We've got a lot of engineers on the book, Matt.
Yeah.
They'll do analysis, projection after projection. But if you never pull the trigger, you're not going anywhere.
Yeah, I agree. Very technical people. And sometimes you can just get too caught up in detail.
Yeah.
Analysis by analysis.
Yeah. And I like to say, I know a lot of wealthy people that probably struggle to put two brain cells together, and a lot of really sharp people who are poor.
Yeah.
And it's just because they never pull the trigger. And if you look at properties or shares, the only thing I can promise you is there will be a slightly better option in the future, but the option you just gave up is going to look more and more attractive as time goes by. So the basics of a good financial plan. We like to get onto the sexy stuff, talking about starting businesses, investing in property, buying shares, but you have to have your house in order before you go absolutely anywhere. Your number one wealth creation asset is your income. If you do not harness your income in the right direction, you are going absolutely nowhere in life. So Mike, we're going to talk about the budgeting slide a little bit tonight. And that is a really, really important piece, but doesn't get a lot of attention.
Yeah, I can like collectively feel the eye roll from everyone who's watching. I promise you, we'll keep it brief. And we actually used to tailor the budgeting slide a little bit to reflect the audience when we go into businesses. But actually, what we figured out is you're all as bad as each other at budgeting. No one's good at it. You know, a bit comes in, you don't know where it goes, you're not left with much at the end. So we're going to make it really easy for you.
Cool. And then we're going to talk about, there's also making an active choice of KiwiSaver, which is a really easy win. You're going to have an investment for a long period of time, paying someone a lot of fees. You might as well decide who that is and whether they're going to do a good job, making sure you've got an up-to-date will, making sure you've got insurance. The other huge thing is jumping right to the end. What are the goals you're working towards? What are you trying to achieve in the short term and the long term? If you have no idea like what you're working towards, you're just on autopilot, kind of floating through the abyss, going absolutely nowhere. So if you are single, then you really need to think down and go, what are those goals? If you're in a couple, you got to have those conversations. Sometimes we don't like to have those conversations because we're tired, we got kids, lots of things going on. Go, I don't want to get yelled at, I'll just skip it. But I'd say probably 9 out of 10 couples have different money personalities, and the way to get on the same page is to have those joint goals.
Yeah.
When it comes to this slide here, our approach to financial planning, I've got some customers who, when they retire, are going to have absolutely nothing. And then I've got those who are going to die with too much money, which is probably the minority, but still a problem. Financial planning is about balancing current you and future you. You have to find the balance between the two. You're not going to be any younger than you are now, get to enjoy your life anymore, right? So you want to be able to make sure you have those experiences. For those that kids, we joke about, doing these things with your kids, having these travel experiences, all that kind of thing before they don't like you. But then also making sure you're setting yourself up for, if it's an early retirement or buying a larger home or being able to, work part-time, having financial freedom. It's all just a bit of a balancing act.
Yeah, absolutely. And I've seen in the chat here, someone's put, I plan too much and I have anxiety. And that's really the opposite of what a plan should do for you, right? That should pull you out of, descending into the particulars on every single detail and kind of get you a more macro strategy. Like, fundamentally, you buy a house here, you buy a house here, maybe another one here, you wait a while, you sell some down. And, a really simple plan like that can mean that, I'm not saying you don't need to look into the details of the transaction, but absolutely just look, I got the widget, I sold some widgets, and now I got some cash. And, we're big on property as an asset to grow wealth over time. Fundamentally, you buy your owner occupied house first. Man, Matt, you're a property guy.
Yeah.
What was your first house like?
I did the mistake that pretty much every Kiwi does.
Yeah.
And I bought something that was too big, too expensive. And my first home I was under quite a lot of mortgage shares.
Yeah.
And that was actually one of the foundational things for Williams Corporation, because I experienced driving all the way to the burbs each day, having this huge house that I couldn't afford, waiting the 4 months for the curtains that I couldn't afford. And then when I changed from that home to a townhouse, which was well within my budget, I was like, I get this. So I had a very interesting relationship with my first home. And that's one piece of advice I would give. What you can afford, if you can, bring it back a little bit. It just makes your relationship with property so much better.
Yeah, 100%.
I like that as well. Like the whole thing, there's no free lunches. Like if you take on a bigger mortgage, I literally just got off a call where a couple was thinking about upgrading their home. There is an implication on the other side. Maybe it's stress, maybe it's, being able to travel, maybe it's being able to retire early. It's just give and take between the two.
Agreed. And it's very easy to think you can, but that payment every single week, every single month, and that really takes from your quality of life, and also the time as well.
Yeah.
When you buy a house, I'm really against buying a house that's miles away. Like there's a study done showing the correlation between commute to work and happiness. We can measure happiness by having a shorter commute to work. So just be careful with that first time. Be careful with the size of the asset. Be careful with the location of the asset. Now, don't get me wrong, we all have to make sacrifices, and it's harder now to buy property than it was when I bought my first home. God, probably 14 years ago now. And you do need to make sacrifices, but just make sure you calculate that risk and make an informed decision.
100%.
Cool. So, Mike, you said budgeting's no fun, yet you're about to tell us about budgeting. So off you go.
I'm going to tell you it's no fun. But look, budgeting gets a really bad rap, right? Like everyone loves talking about the sexy stuff, the investment properties, the funds under management, selling things down, buying assets. Everyone wants to talk about these like crazy share spreads that they're doing and all of this sort of this golden butterfly, this, that, and the other. It doesn't matter, right? None of that makes sense unless you fundamentally know the numbers of your spreadsheet. And it's like a business. You've got to know the numbers to know what's going on. And you might think you know what's going on, but I promise you don't if you don't have a budget. And it's basic, right? Some income comes in, you've got some fixed expenses that go out, you have some fun, and then you save the rest. That is the wrong way to do it. The savings portion of that is the only portion that is getting you ahead. Everyone has the fun first and then the savings. What you've got to do is start with the goal and work backwards, right? So if your goal is, I want to buy a townhouse in a central city and it's going to cost me 550,000. I need a 10% deposit, 55 grand. I've got 3 years to save it, and you just work the math backwards. And, if that doesn't work, you've got to change either the goal or the time to achieve the goal, right? So again, budgeting, I know it sounds lame, but if this is the one thing you do off of this podcast, the one action you take, sit down, sum everything up for the month and just see where it goes. I promise you can trim stuff out of there to achieve your goals faster.
And your income, like when we say it's your biggest asset, it's like the start of the snowball. So if you can save up that 10% deposit Mike alluded to, then that allows you to buy the property, right? Property starts going up in value, then you start paying down the debt. Then you've got equity. Then you can buy a second property. And we'll talk about that leverage component and how it builds. Then we eventually have our mortgage gone. Then we can start contributing to shares, and it builds and it builds. Maybe you're in a stronger financial position that allows you to take control of like a business opportunity that if your finances were in a certain order, you wouldn't be able to do. That's why the income is the start of everything. Mike and I have clients who earn well over $1 million a year, and they spend $1 million a year. And I know that sounds crazy, but lifestyle creep just blows out of control. And then these people are just in these super stressful positions on the treadmill of life, just sprinting, and they've got no way out because they built all of this life around them. So if you can't manage $50,000 a year, even if it's just you're breaking even and you're not going into credit card debt, there's no way you can manage those bigger incomes. So managing your income is super important.
Yeah.
Cool. Okay. So the other thing, which we're going to talk about the share market, but don't worry, Matt, I'm going to link it to the property market. So a lot of the discussions right now are around timing and when is the right time to invest? Where are we in the property cycle? We're going to have an energy crisis and then the market's going to go down further, or something's going to happen, which means I'm going to wait to buy later. So we're going to talk about a study that was done from the year 2000 to the year 2020, where you have $2,000 to invest per year and 5 different investing styles. So Mike, let's go one for one through them.
Cool. So first one, Peter Perfect had the best skill and or luck, and he had put his $2,000 in the market every year on the best day in the market, which is the lowest point. That is impossible to do.
So just to be clear with the market, this is the S&P 500, top 500 companies in the US. Second style is Ashley Action. She doesn't muck around. First trading day each year, she puts her money into the market.
Cool. Matthew Monthly. So he divides his $2,000 up to 12 equal portions and puts them in at the start of the month. We call that dollar cost averaging. It's really what you're doing with your KiwiSaver, just drip feeding into the market.
And then Rosie Rotten is the complete opposite to Peter Perfect, and just as unlikely to happen. She invests in the highest point each year, which is the worst time to invest.
Cool. Last one, Larry Linger. So probably an engineer.
Probably.
Does another spreadsheet, leaves it in cash, doesn't get around to investing it. There's always a better opportunity next week. So it doesn't put money into the market at all. So we've got a quick quiz here that will pop up. Now, which one of these do you think gets the best results? Now, this I find really fascinating because we get basically the same answer every time. James, is this a trick question?
It is not a trick question. So please fill out the result. So $2,000 each year over 20 years. Which style works best?
Matt, what do you reckon?
My brain says the perfect person has to win, but then I think it must be a trick question because my brain's like, if you pick the timing of the market perfectly, my gut feeling is the perfect person needs to win, but it will be followed very closely by, like, there'll be hardly anything in it to the dollar cost average person. Yeah. And then the action person will be not far behind that. And it'll be only tiny nuance between the three.
Right. Okay, let's have a look at the results.
I'm all expectation.
Matthew Monthly. So this happens every single time. People think it's a trick question. Yeah, Matt, you're right. Peter Perfect is perfect by name. Yeah. So Peter Perfect is not that interesting because he's perfect.
It's impossible.
What's interesting is really the rest of them. So Ashley Action and Matthew Monthly are not that far behind by just putting the money in the market in some form. The two interesting ones, Rosie Rotten. The reason why Rosie Rotten is interesting, she picked the worst time to invest 20 years ago, but she still invested in 20 years ago. Then she invested 19 years ago, 18 years ago. There's a reel around Instagram around this lady walking out of an auction in Canberra in like the 1960s. And she's like, land prices for $2,000. I'm just going to wait for them to drop in value. And of course, we know what that's like. And the exact same thing is going to happen. The people who bought property in 2021, they're feeling pretty sad at the moment. Yeah. But I'm sure, Matt, that's right. But I'm sure you can talk to you, right? If we give those people enough time, they're going to be laughing. It's just short-term.
Yeah, it's very, very short-term. And it's like, don't get me wrong, it's hard for an individual that bought an asset and watched it decrease in value by 10% or 15% or whatever. But like you say, in the scale of time and the scale of participating in the market, it'll be inconsequential in the future.
And I know you've got some really cool graphs on the property side to illustrate that with the GFC. But Mike, I want to talk about Larry. Tell me about Larry.
Yeah. So
is that held in cash?
Yeah. That is held in cash.
Yeah.
And I would argue that's even worse than that because cash is devalued even more brutally than what you've got on the chart.
It's going backwards. And that's the thing, right? At the top of this, we talked about the Lighthouse mission statement, right? Which is education plus action, financial freedom. The action piece is the big one here. And if nothing else, you can substitute this S&P 500 for the property market, for basically anything, right? If you just take action and get in the game, buy the property, invest in the market, do the thing, start with the budget. Even that is a form of taking action. You will fundamentally be better off in the future. And to James's point about these people in Canberra buying these, houses for this land for $2,000, do you really think it matters if your grandma who bought, I don't know, an ex-state townhouse just off Ponsonby Road for, $2,000, waited 6 more months just to see if it'd go down to 1,800? It's now a $5 million property, right? And humans struggle to comprehend the power of compounding returns. And it is literally the most powerful force in the financial universe. You are compounding returns on returns on returns. So again, Larry Linger, that's who we're here to save.
Just so the audience knows, this whole first part of the presentation has nothing to do with me. So that was genuine.
Yeah.
And I was racking my brain as well because I'm thinking it seems too obvious that it's Peter Perfect. But the trick in the presentation is the difference between Peter Perfect, Ashley Action, and Matthew Monthly. And even the lady that invests the worst, it's almost inconsequential in the scale of the investment.
And Ashley Action and Matthew Monthly, basically dollar cost averaging by different,
You have to save 3 times as much money if you're Larry Linger, right? And it's the whole working smarter, not harder idea, deploying your capital over and over again. And honestly, we talk to a lot of Larry Lingers and they will go and look at an investment property and they'll be like, here are the 3 options. What do you think? And the first time I'll be like, well, this option's slightly better. Once we get to about 3 or 4 months in, they'll go, what do you think of these options? I'm like, just buy anything. Just do anything and it'll work out all right.
Yeah. I have a saying and I'm like, make a decision. If you can't make a decision, flip a coin.
Yeah.
No, because the most important thing is the decision. Because most people aren't in a situation where they can actually do too much damage with their decisions. Like if they're choosing this stock or that stock, if they're choosing this house or that house, they're not actually big decision. Or it is, but it's not damaging.
The downside risk is not exponential. Whereas the upside is.
Yes.
So the takeaway from this is do something. That is really the big takeaway. Take action consistently over time like Mike said, periods of time. The other one I don't get at all is people go, oh yeah, but property prices won't double again over the next 10 years, or property prices won't increase 5%. And it's like, what's going to change? Nothing's going to change.
I actually find it interesting as well that the Ashley is more than the dollar cost average. So just throwing the money in the market on the first day of the year is better than a dollar cost average. That goes slightly against where my brain was mentally.
Yeah,
it's really,
just more time in the market. Yeah.
Cool. So now we've got a good one. We can do this. We can make this a bit of fun. Yeah. You know, you two versus me. Let me talk about shares, gents. Shall I talk about shares? Okay. Pound for pound, shares are 100% a better investment than property.
Said no one ever.
Why? Higher net return, 6%. Second, much more liquid. And third, far more diversified. So in this investment, we've got shares, an initial investment of $140,000 with a whopping 6% net return minus fees and tax. Gentlemen, beat that.
Take it, mate. Take it.
So, firstly, in property, the person gets significantly more leverage than you have access to in shares because the asset is seen as more stable. If you go to Westpac and you're like, hey, Mr. Westpac, I want to buy $1 million of Westpac shares and I have $100,000 deposit. Can you loan me $900,000 to buy your shares? He would laugh you
straight back out the door.
His office.
Yeah. This is true.
So the bank does not value their own shares in the terms of leverage as much as they do with the property market. So step number one, you're getting leverage. Step number two, you're investing in an asset that psychologically people treat better. Now, you said shares are liquid, and that is a good thing. But for most people investing, I would argue maybe it's not. Like
helping them from themselves.
Yeah, people see that.
And we see this with KiwiSavers. There's a reason you can't get access to your KiwiSaver.
Yeah. I would argue the not being liquid is actually beneficial, and that actually makes the investment better. People appear to be more disciplined paying their mortgage. People appear to be more disciplined not withdrawing equity from their house. And so then what you have is you have the property increasing in value. You have the debt decreasing in value. You're borrowing money, which is decreasing in value. And then you have a tenant paying the holding costs and the maintenance costs of that asset. And that's where you can have transactions with very, very small amounts of capital turning into huge numbers. And when you see these transactions where someone bought a house for $100,000 and they sold it for $1 million, they might have only put $5,000 of true cash into that investment. And when that asset's divested at the end of the transaction, the wealth creation from that transaction is significantly more than what you'd see in a share speculation, unless it's like you're the one dude that bought Microsoft for like 3 raspberries.
But the issue is with that one guy, and we always get asked this during our presentations, that everyone wants to know, what is the next Apple? What is the next Nvidia? What is the next, like big thing? And I'm like, it doesn't matter, because if you bought it, you would have sold it when at 3 times the price, and instead of when at 3,000 the price, right? Because you are just human like everyone else. You thought, oh crap, I bought this pile of nothing for 3 cents and now it's worth $30. It might be 3 cents tomorrow, so I'm going to get rid of this thing, right? Which is the opposite of property.
I do agree. Leverage is a great tool.
Leverage.
That you can turn, in this example, $140,000 into $700,000. So this is the numbers. Shares about $8,400. Property, once you factor in all of your costs, $20,000 a year. Now, I'm going to rebut. There is scenarios where shares do make a lot more sense, and that's when people are focused on income. Now, there may be some scenarios where Airbnb or regional properties with decent rental yields, but gentlemen, you cannot sell a bedroom to go on a holiday, but you can sell some shares to go on a holiday. So I do talk about the right tool at the right stage of life. So when you have income, when you've got income, you don't need income from your investments. Leverage is your best friend. But property makes you rich on paper. It doesn't give you cash flow. It's quite hard to do. So that's why when we talk about, and one thing I really struggle with Kiwis is they go, look how much money I've made from property. And I go, you got to do something different now. And they just look at me like I'm an absolute idiot. But I go, might be true, but it's because you need to switch, because we need to go with income. So I would say right tool for the right stage of life. Property leverage, very hard to beat.
Absolutely.
The good thing about a property though is if your wealth is tied up in property, you normally don't get poorer. Like people aren't drawing down on their equity, they're spending. So like arguably, maybe you shouldn't be decreasing your share portfolio to go on that holiday. Maybe you should be trying to structure your life where you're living off the income produced, not dipping into that wealth. Like, it's hard, right? Because you only live once.
Well, it depends on the level of your wealth.
Yeah, and it depends on the level of wealth.
Yep.
Yeah.
That was far more responsible, gentlemen. I'm disappointed in you both.
Mate,
all right.
don't worry. When the camera turns off, we're both just going to absolutely climb into you. Yeah.
Right. So there'll be some people in this audience that I haven't met before. So 30 seconds on who I am. My name's Matthew Horncastle. I'm the director of Williams Corporation. I come from a property family, so everyone's in construction: mother, father, auntie, uncle, granddad, cousin, the whole shebang. I'm a qualified builder, so I've served my time in this industry from the ground up. I've owned a business since 2011, so becoming quite the battle-hardened businessman. I'm a thought leader in the New Zealand business space. You'll quite often see me on TV or on the radio or on podcasts like this, talking about business and talking about property. But my largest claim to fame is I'm the co-founder of Williams Corporation, which is one of the largest privately owned builders in New Zealand. Who is Williams Corporation? Williams Corporation is a residential property developer. We build homes that are affordable to buy, affordable to live in, affordable to maintain, where you can live, work, and play. A little bit of our dashboard. I don't like this slide, but I think it's important because there's a lot of people that say they're property developers, say they're property people, that haven't done a lot of property things. So what this is emphasizing is the quantity of business we do, and it's just showing our track record currently in the marketplace. So last financial year, we delivered 338 houses to our customers, $250 million, and that's in a really tough market. So we're doing a huge amount of transactions in a very tough market. And in our career, we've built over 2,000 homes valued at $1.2 billion.
Yeah. And just quickly to jump in here, when we're looking at numbers like these, why is this important for a developer to have, this sort of backing behind them? Because we see, as a mortgage broker, I see different developers come across my desk every single day, and I constantly get asked, is this a good developer? Right. And I'm like, well, you tell me.
Well, me personally, I'm a significantly better property developer. 31-year-old Matthew is a significantly better property developer than 21-year-old Matthew, because in those 2,000 homes, I've learnt stuff. And it sounds dumb to say, but like, you didn't put the tap correctly on the back of the house. It only had the outdoor tap on the front, and then you couldn't water the back garden. And we've got we've got pages and pages and pages of checklists from all the mistakes I've made in my career, which we then make sure we don't make that mistake again. So quality of product. We build meta knowledge. That means we create a better quality product where the mistakes we made, we don't make again in the future. And then the second thing is balance sheet. On those times where there is a fundamental problem, we have the ability to write the check because we built $1.2 billion worth of stuff and we've got a bit of cash. So you as the customer, you're making one of the largest decisions you're going to make in your lifetime. And you want to know if something fundamentally goes wrong, can someone write the check and fix the problem? So what you're essentially getting with a larger property developer is that balance sheet, which really helps. So one thing to emphasize, we're not real estate agents, and people sort of can't fathom the numbers. But this slide is just to say, each of these houses, we had to buy a block of land, get the consents, sell it, build it, door handles, paint, title, code, 1-year defects period, 10-year structural period, times 2,080 houses. So just emphasizing, we've done a huge amount of work and built a huge amount of meta knowledge within the business from that work. So these are the fundamentals of how I see the New Zealand property market. So starting with psychology, you are beaten as the consumer, as the public, that property operates in a cycle. And it kind of does. That's kind of true. So you're told the property clock is a beautiful tool because it's an easy way for us to visualize what we're told. So the property clock's very simple. 12 o'clock is the peak of the market. As we go from 12 to 3, the market's slowing down. As we go from 3 to 6, the market's essentially slumping or collapsing. Then from 6 to 9, it's recovering. And from 9 to 12, it's booming. Now, when you talk to people, I do presentations all over the country. I'll quite often put the property clock up because it's a great way to get engagement. And people will yell out where they think the time is. And the answers I'm getting from people in the current market is anywhere from sort of 5 to 7. Depending where you are. People in Christchurch are yelling out 7, sometimes 8. People in Wellington yell 6. People in Auckland still yell 5. But the summary is people believe we're thereabouts at the bottom of the market, either just before or just after.
Yeah.
Would that be the mood you're getting from your audience?
Yeah, 100% right. And I think what's really important with this is to, and Matt, as Matt will expand on, is it is very easy to say things like, oh, Warren Buffett said buy low, sell high, you know, but it is actually very difficult psychologically to buy low because you're buying in the slump, right?
Yeah,
When property is down, and to your point about
Yeah.
the media, everyone in the media is telling you this is a terrible time to buy.
Yeah.
Interest rates are high. There's economic uncertainty. No one knows, you know, if this is the light at the end of the tunnel or not. So it is very difficult to actually do it. We are starting to see some green shoots, though, in terms of, you know, the forecast from the Reserve Bank saying we're potentially going to get a rate cut by the end of the year. So that's why I would say we're probably a little bit past the 6 and starting to come into the 7. Yeah.
No, I agree completely. And what's interesting, do you know who's buying now? The wealthiest institutions on earth. BlackRock's buying with a vengeance. But we'll get through that. So I love this graph. So what you're looking at now is the New Zealand median house price. And let's just break out this data. So this is back since 1993. So this is actually my life, which is really interesting. Now, I want you to first look at 1997. I normally have a clicker where I can show you. But if you focus your eyes on 1997, what you're looking at is the Asian financial crisis. Now, at the time, that was a huge economic event. In the scale of time, it looks almost inconsequential, right? Then we go through and we see 2008, so the global financial crisis. For the younger people of the audience, you ask your father, you ask your grandfather what 2008 was like.
Yeah.
They'll say it was a very, very difficult economic time. They'll say asset values took an absolute hammering. They'll say liquidity was really hard work. In the scale of time, if you didn't know 2008 was a time, you wouldn't even notice it looking at that graph.
You'd say a plateau.
You would say it's a plateau. So now we've got this COVID event. And so we have this huge rally of asset values followed by this collapse in asset values. And it is stark, don't get me wrong. Asset values escalated more than they have and declined more than they have. That is factually true. But we will be looking at this graph 5, 10, 15, 20 years from now, and that'll be another inconsequential blip in the scale of the asset. And essentially, the main thing we're taking from this is we can look at this asset, which is the New Zealand median home, and we can say it's reasonable to assume that assets values will continue to increase over time.
Yeah. And the trick to real wealth creation is a lot of people think in 6 months. You need to think in a decade. And if you think in a decade, you go, is this investment a good investment over a decade? You look at the graph, you look in the 2000s and the 90s, there's no volatility. And as time goes on, the volatility kind of stands more out. If you buy right now, do I have confidence that the property market will increase over the next 6 months? No. Do I have confidence that it will increase over the next 2 years? A hell of a lot more confidence. Do I have confidence it will increase 5 to 7% per annum over the next decade? Absolutely.
Yeah, I agree. So now we look at forecasting. So we've come out of this event where we had this really sharp increase, really sharp decrease. We've had this pricing volatility. And I don't really like taking expert opinions, but I think it's better to quote some of these institutions. When we look forward, Westpac thinks house prices are going to increase circa 5% until 2030. Tony Alexander thinks we're going to see a house price increase of 10% in the next 12 months. I look at it and I look at the past data and I say for the previous 42 years, the New Zealand median house prices increased by 6.8% a year. I think we're thereabouts. I think we can look at the asset class and say that it's going to move generally pursuant with what we've seen in the past into the future in a significantly more stable manner than what we've observed in the past sort of 4 years. And one of the reasons why this asset continues to increase is our population. So when you look at New Zealand's population, it's this beautiful, steady march of people. So there's currently 5.3 million people in our country. And at that tip, at the top right of that graph, you see it sort of starting to increase more. Now, because we're dealing with such big numbers, it's not as stark as it probably should be, but what you're looking at is a huge increase in people. And I want to break down what that 12 months looked like. So in the last 12 months, New Zealand's population has increased by 152,000 people. That is 3%. There are a lot of developing nations that aren't growing at 3%. 3% is a massive number. So breaking down that data, we have 130,000 net increase from migration. So people coming into the country, that's net migration increase. We have a births over deaths, so our natural population growth of circa 20,000 people, making up that 150,000 people. Now, the New Zealand median household has 2.6 people living in it. So for us to maintain our current standard of living, let's just assume that people per household would match standard of living. There's a few arguments that it does or doesn't, but inconsequential. To match those median people per household with the households that we require 58,000 houses to keep up with the last 12 months worth of population growth. Now, everyone, you're all smart people in the audience. You already know the next slide before I put it on. One more slide, sorry, Nick's throwing this out of order. So this is how many houses we build each year. So the New Zealand construction industry builds circa 25,000 to 32,000 houses per year. Now, people quite often get confused and they'll look at building consents issued and they go, there's 50,000 building consents, we're there. And it's like, whoa. Big difference between drawing a house and building a house. So we have a fundamental issue. We are not building enough houses to keep up with the population growth of this country. And that is why the asset class has increased so much over time.
And just to jump in, why do you think that is? What is it that's stopping New Zealand from being able to deliver that many houses?
So few things. Starting 5 million people is actually not a lot in the country. So we actually have a very small population.
It's half a city somewhere else in the world.
Well, it's a Singapore. All right. And then we have a small population. We're globally placed in a very inconvenient place. We're not really that close to anything. And then we're geographically very difficult. So like for proper supply chains, let's say you're a German conglomerate that makes plasterboard. It's not attractive, right? Do you build a factory? How does the factory service this country over 3 islands? The highways aren't great. So like you've got the supply side. Then you have, look, there's a reality. Our councils have restricted supply in a manner that's not acceptable. Our Resource Management Act has been very, very hard on house prices, that it shouldn't be as restrictive as it is. Building authorities and all of that, it's significantly more restrictive than it should be. And our standards arguably are probably too high. There should be a manner to build houses in a more cost-effective way, to provide housing that's more affordable to the marketplace and let people decide the quality of home that they want to
based
purchase.
On the price.
So but the thing is, anyone that says, and it really annoys me when people stand up on the news or something and they'll say something like, the reason houses are expensive is we need to prefabricate. If anyone explains the problem with one simple or one sentence, they have no idea what they're talking about.
Let me just fix this in one stroke.
If you're a real pain in the ass that takes 15 minutes to articulate the problem, right, and the nuances of it, you're dealing with someone that's being more honest. So lots of little things that we need to do better as a country. Jumping back, sorry, we've got there. Now, this is a really interesting slide. So this is New Zealand median rents for the last 10 years. And essentially what's happened is almost perfectly for the last 10 years, the New Zealand median rent has increased by 5.5% a year. Right now, in the last 12 months, it's increased by 9%. So almost 100% increase, almost double the 10-year average. And what you're starting to see there is pressure in the system. That's those immigrants coming in. That's the
interest rates.
The house prices not quite. So we're starting to see that pressure in rents, which I personally believe is going to flow through to pricing of houses. So now on top of this, we have the replacement cost of homes. So essentially, we're going to discuss two things here. You have consumer inflation, right, which is what we all deal with. I think most Kiwis now have a really good understanding of CPI just because it's been hammered into them, especially your audience that watches shows like this will. But then what we have and what I deal with is construction inflation. So rough rule of thumb for construction inflation is it moves 2 to 3 times CPI. So at the moment, consumer inflation is running at 3.3%. Construction inflation at the moment is about 9%. I personally believe it'll probably come down to about 6%.
Yep.
But the main thing is it doesn't come down to 1 to 3.
Yeah,
Right?
it's still going.
So every time we build a house, it is significantly more expensive than it was before in a manner that is disproportionate when compared to CPI.
Yeah.
Yeah. So now we come to the official cash rate.
Let's go.
Yeah. So what I find really interesting about this graph is how we've dealt with financial events in the past and essentially what happened. So when we look back to 2008, it becomes very, very clear that the government left the official cash rate too high for too long.
Yeah.
They did fundamental damage to the economy. And once they realized how much damage they did, they had to do really, really aggressive cuts. And I think we're in the same place.
Yeah.
I think the Reserve Bank has left rates too high for too long. I think they've done damage far deeper than what is appropriate.
Yeah.
And we're going to see drastic cuts to stimulate the economy appropriately.
Yeah.
So looking at that data, I think that's quite stark and almost quite damning.
It is quite interesting looking at the GFC, and they talk, the Reserve Bank will be focusing on a very soft landing where, cuts will happen slowly over a period of time. But in reality, Mike, that's quite tricky to do, isn't it?
Yeah. And I guess really the issue with the Reserve Bank has at the moment is they have to wait until that inflation number comes back within the target bounds before they cut, right? And one of the main reasons for that is next time that they go to do this, if they say, oh, yeah, we are gonna hold the line and we will hold the official cash rate up until we come back inside that target band. And last time they didn't, the market won't take it seriously.
Yeah, and
the issue that the issue that I think really the Reserve Bank has in terms of holding for too long is the lag on the data. And that they don't have up-to-date data. Like, you can look, when we talked to Jared Kerr, he was like, forget the official cash rate. What I look at is transactional spend data and a couple other key indicators in the data that they have, right? And they are like, I know exactly where inflation is going to be because I can see real-time data.
Yeah, and you think about, so like you look at that, so inflation rate's at 3.3, the Reserve Bank wants it to be between 1 and 3. You then start to look at within that 3.3, where is it sitting? It's not the imported stuff that we've spoken about before, it's what's happening within New Zealand.
Rates.
And rates and insurances are the big ones. And the question is, what are they going to do with them going forward? Because council's a mess. I can't imagine rates getting fixed anytime soon.
Ones?
Yeah.
30% increase in some places.
Yeah, and so that is skewing some of the data, and there's a delay in the data. And if you talk to anybody in New Zealand, there is a hell of a lot of pain out there. So I can completely understand where, in hindsight, we look and go, that was obvious. Yeah. And I don't know if it's going to be to the GFC extent, but this soft landing that the Reserve Bank's trying to land might be very hard to do in reality.
Well, it was also inappropriate when we put the country into lockdown and there was no productivity to drop rates so much to stimulate growth when we physically couldn't create growth because we couldn't work. So like we dealt with decisions that were inappropriate to drop rates so low in a manner where you could not create productivity because we physically weren't allowed to work. And then once assets got extremely overvalued, then lifting it really high and having the Reserve Bank saying, I'm going to put the country in recession and doing so. I don't know. It's not how I would have run it. I think that it needs to be done significantly slower, kind of like what you see in Australia, significantly less. And they're a lot more concerned with mum and dads, with the average household, and making sure that they have a good quality life and that they're not being choked by their mortgage.
Yeah, and you can see that there, right? You have a market distortion, which is the Reserve Bank cutting rates to almost zero. And then you have an inflation, like a massive inflation in asset prices caused by, an artificial market distortion. And then you have a correction off the back of it. And what we're going through now is that correction. None of it happened by chance. It is all by design. It's just that perhaps the design was a little bit wrong.
Well, these are all government decisions that have harmed the population, and we do need to do better. But I think the main purpose that we take from this slide is looking at the data. It's clear during the GFC, they held it too high too long. They significantly damaged the economy and they had to aggressively drop it. And I think we can look at this with a high degree of certainty and say it's been held too high too long.
Yeah.
And we're going to see very sharp drops. Like when they say 8 drops in a row, I think that's bang on.
Yeah.
When people start talking about first cut being 50 basis points, I'm not disagreeing. And then as we see this cost of money fall through the floor, what's this going to do to asset values, especially property? I think it's reasonable to assume it's going to make property significantly more attractive.
Yeah.
So let's jump into house prices really quickly. Last month, the national house price got more expensive by $2,300. In the last 3 months, the New Zealand median house prices got more expensive by $7,000. Now, the last property cycle, the global financial crisis, we had 5 quarters of house price decline, so 1.25 years. Then we had 41 consecutive quarters of house price increase, a 10-year bull run. Now, that period was absolutely beautiful because that's when I built Williams Corporation. Oh, what a time to be alive for the younger audience. It was a lovely, lovely period. Now, we've just come out of another economic event. Let's call it the COVID event. And we've had 5 quarters of house price decline. We've then had this period where technically I can say house prices have been increasing, but when you see the numbers above, it's best for us to just say there's no consequence.
It's flat.
It's flat.
Yeah.
We're seeing a flat housing market. But I think we're going to see easing in a massive way. And I think we're going to be entering into this bull period of somewhere in the vicinity of 5 to 10 years until we hit the next global event and the next low quality round of decisions from government.
Again, we're talking about taking action. And again, it's whether it's just getting a budget or going out, buying a house, doing this. If you are trying to save a deposit and in a flat market, the amount that you have to save just increased by $7,000 in 1 month, it is very difficult to outsave a moving market, right? And if you're only saving $7,000 a month, you might not be going anywhere.
Oh, I know. And when that moves in a scary manner.
Yeah.
Like New Zealand median house price at the moment, call it $800,000. If we start moving at 7% a year, that's $65,000 a year.
Yeah.
20% of 65,000, you need to be saving $12,000.
Yeah.
Like it is hard to catch up to a moving market. And it's hard psychologically. It's hard to miss out on a house 1 month and then have to pay $10,000 more to buy the same house the next month.
And the other thing to point out is the market you buy in will be different in a year or 2 years' time. It is a buyer's market at the moment, right? Like you can have really good conversations with Matt around lots of stock options. When you're talking to Mike, you know, if you're buying your first home and you're buying an existing property, there's negotiation, there's deadline sales. But you think, I remember there was periods at the top of the market where you'd put a listing up and you'd have
It'd be at auction 30 seconds later.
10 townhouses to sell and you get 30 contracts, right?
No, I can do better than that. I released a block of 10 in Wellington and it was 11 and I received 110 offers.
Yeah. And
so we're 10 for each one house.
Yeah. And the big thing, right, is we are far too short-sighted. So like when we're in good times, we think good times are going to last. When we had that 2% interest rates and boy, was it good. We thought it was going to last. We now think bad times are going to last because we've got everybody telling us that life sucks and things are hard because that's what sells clicks and newspapers. And we think 7% interest rates are going to stay around forever. The guarantee around life, good times, bad times, high interest rates, low interest rates don't last. And that's why you need a plan to deal with the cyclical nature, to not think short-term and emotional, but think longer term.
Yeah.
I've seen a really amazing study and it was the average cost of capital since the time of Jesus.
Yeah.
So 2,000 years and it was 5%. Yeah.
Wow.
So there's something about that 5%.
That long-term average.
That this appears to be how society functions.
Yeah.
Yeah. So what's my summary of the property market? There is a property cycle, but the cycle is marching in an upwards direction. It's not as boom bust as you psychologically think it is. Median house price of New Zealand is increasing. New Zealand's population's increasing. We're having rental increases in a manner that is significantly higher than the 10-year average. We have a fundamental imbalance between supply of houses and population growth. Replacement cost of houses moving at a rate disproportionate to consumer inflation, where it's reasonable for us to say interest rates are about to drop. And even in an environment where you get a mortgage at 7%, house prices are still increasing,
Yeah.
which I find absurd. Small increases, but still increasing. So we're trading in an environment where we're facing economic tailwinds, not economic headwinds, and we can have optimism that tomorrow is going to be better than today.
Yeah.
Definitely. Survive till 25 is the thing.
Yeah.
Okay, so I have to present you something, and I want to show you an example of what you can purchase from Williams Corporation, but I'm not going to have context unless I tell you where it is. So starting with Christchurch, my hometown. Now, Christchurch is an amazing city. It's a population of 400,000 people, but I don't want you to think of it as a city of 400,000 people. I want you to think of it as the gateway to the South Island, which has 1.2 million people. Back in 2011, we had an earthquake that fundamentally changed our city, and we've entered in since then to a $40 billion rebuild. And what this done is given us this huge amount of money, but the ability to master plan a new world-class city. So why do people like Christchurch? We've got a huge amount of employment. Also within that employment, we have opportunities to do the same sort of employment that you would get in a city like Auckland. So we have very, very similar jobs to the metropolitan jobs you have, but we have a very, very high quality of lifestyle, and we have very, very affordable houses when compared to Wellington or Auckland or Tauranga, etc. And then we've just got some amazing assets, which I'm going to talk to you about soon. So this is an example of a development you can purchase from Williams Corporation. This is 31 Allen Street in Christchurch Central City. This consists of 14 one-bedrooms and 10 studios, with studios priced from $409,000 and one-bedrooms priced from $485,000. Now, what's really interesting about this project is it's consented for short-term accommodation. So what you can do is you can actually take the GST off. Now, I'm not going to discuss that too much here, but you can essentially take 15% off the purchase price. And actually, you guys are better to show them that in an individual one-on-one. So location of the development, the key thing I want to show you is there's 4 AVs, which hopefully you can see, it's hard for me to point out, that represent the city of Christchurch. This project's right in the city. So you're only sort of a 2-minute walk down to town. Now, it is only 400 meters away from the Takaha Stadium. This is the new Christchurch Stadium under construction. When you look at this asset, it's amazing.
Yeah, cool.
Like huge. So this is a 35,000 seat covered stadium. It's costing $750 million, and they're going to have 40 events per year.
Yeah.
So an amazing asset for Christchurch Central City, and it's only 400 meters down the road from this specific project. Now, also 150 meters down the road is the Ara Polytechnic. So that has obviously a huge amount of students, 19,000 domestic students, 2,000 international students. God, I was saying that weird.
Studio and
students. So when you have fundamental assets like this, you can look at it and it's reasonable to assume that there's going to be demand for an asset of this nature. So typology of the project, you've got 2 west-facing buildings. Through the middle of the development, you have these cool communal areas, bike areas, waste management. The development really links together well. Really cool central city project. Now, in the project, you essentially have 2 types of units you can purchase. The ground floor are studios. So if we look at the middle left side, that's an example of the ground floor studio. I'll pick a middle unit because it's one of the least desirable ones. So the end units obviously get better from there. Now, the middle unit, you can see you come in the front door. You've got that bathroom, storage, kitchen, storage under the stairs, wardrobe area, space for your bed, space for your dining, space for your couch, space for your living. Now, for the short-term accommodation investors, you can put a fold-out couch. So this unit can sleep 4 people. Then it opens up onto your private courtyard. Now, for the 1-bedroom units, you go in your own front door up the stairs. You've got that balcony, 8 square meter balcony. You've got your dining area again, where you can have your fold-out couch, TV, kitchen, dining, full bathroom, bedroom, heaps of storage space. So lovely, lovely option for a central city unit, both for rental and for short-term accommodation. So looking at the appraisals, so these are short-term accommodation appraisals provided by independent providers. So we've got 2 here, and we're roughly looking at $140 to $145 a night. They're estimating occupancy to be circa 80%.
Yeah.
So we're looking at incomes of sort of 40,000 on one, 45,000 on the other. Let's call it 43,000. Purchase price 480,000. So you're getting like a 9% interest
pretty good.
Which is fantastic for the quality of the location. Now, if you look at traditional rental, you're looking somewhere between 400 to 480 a week. I would argue that's a little bit light because, as you know, rents are moving so quickly, it's hard to hit the bullseye.
Yep.
but you're roughly a 4% rent return. Now with the studios, the return is slightly better. So you're looking at $125 a night to 140. We've got returns here of sort of 37,000 on one and 43,000 on the other. Let's call it 40,000. You're buying it for 409,000. So you're a 10% gross return.
Yeah.
So lovely asset. Yeah. And then rental, you're looking at sort of 5 to 5.5%. So lovely looking project right in the heart of the city, affordable, great returns, great quality developer. That's something I'm really proud of. That's something that I would sell my mother, I would sell my cousin, because I can just see it. I see the quality of the location, I see the quality of the project, and I'm super comfortable with an asset like that.
Yeah, especially being like, we're always talking about when we're looking at locations for houses, it's like somewhere where a young professional wants to live or next to some of those like key landmarks, right? And like in Auckland, we're always saying like, next to like a shopping center or a bus lane or something like that. And to be so close to both of those large assets for Christchurch is a real win for the location.
Yeah, and I could go on and on and on because there's so much in the city.
Well, last time me and James were down there, we walked everywhere.
We loved it.
I was like, it's dead flat. I was like, this is amazing. We went to the wrong office. We had to go to another office, and I was like, oh, mate, this is getting just wandered across the city. It was so nice.
Yeah, it's a real easy, really good quality of life. Right,
cool.
Guys?
Okay, so this is just for those who are going, this is all great, but how do I actually apply this to my situation? So there's two things we're going to do. One is we're about to open up the Q&A, which is our favorite part. So I think we've got about 10 questions in there. We've still got over 100 people on the call. So put in your questions. We'll answer them at the end. If you want to talk about putting a financial plan in place, if you have questions about your own situation, so I run the wealth team at Lighthouse Financial Advisors, who will link the right investment strategy to your goals. And like we said, the purpose of finances, you can't be happy unless your finances are a certain level in order. Now, you might disagree with that. Money buy happiness, doesn't buy happiness. It's 100% true. You need to get it into a certain stage. And then you need to work out what is the right strategy for you. So we will help you work through the goals, help you work through your budget, work out the right investment strategy for you, and give you that clarity moving forward.
Scan the QR code.
QR code.
Cool. And if you think planning schmanning, I want to go buy a property. Where's the money, Mike? Scan the QR code to talk to the mortgage team. So we are everything property and debt related at Lighthouse. So we can talk to you about how much you can borrow, where might be best to borrow. We can give you advice on specific properties. We can actually go and get you the money. If you've got an existing loan, we can talk to you about interest rates. And obviously, I don't mind giving my opinion on where I think they're heading. And I am making sure that I give my advice to my customers based on that. But anything property, come and have a chat to us. We'll make sure you get what you want.
And if you're looking at the calendars and going, they look very busy. We are very busy at the moment, but more than happy to have a chat to all of you. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
When it comes to the podcast, so we believe education plus action equals financial freedom. Education, so action is having a chat after this. Education is not done in one session. So checks and balances, we've got like more than 200 episodes in there. I think we're
a really good episode with Matt.
Yeah, we did.
Yeah, it's comfortably sitting within our top 5 of all time.
Yeah,
that's actually that.
That's not good enough.
Look,
one more
David
time.
Seymour, slightly more popular, but you can come back and take number 1.
There's only one. Whenever I do something, there's only one place I seek.
Yeah.
And it's not 5. But I probably am like the 5th biggest builder in New Zealand currently as well.
Like,
so it's probably what I deserve.
Yeah, and I've definitely done that on purpose, so you'll come back.
Okay.
So check out the podcast, Spotify, YouTube, Apple.
Cool. And if you want to have a chat to the Williams team, Matt, how should they get in touch with you?
Well, you're welcome to contact us anytime. I would probably, because I'm a guest on your show, this is your thing. I reckon you guys should go through your sales channels.
Yep.
And if property is right for you, you can then refer us through. But look, I'm Matthew Horncastle. You're welcome to inquire anytime through any of my channels, or you can go on the Williams Corporation website and find us. But I highly recommend going and doing the financial plan. if property is right for you, they'll spit you through to us and maybe a few other property developers, and we can see if we're right for you.
Cool. Awesome. Okay. So we've done a good job because we've got well over 90% of the people still on the call after an hour.
To the participants that are left, oh, they can't hear me. I was going to say, don't, because the Q&A is like the best part.
Yeah. So let's jump into it. I'll ask the questions. You guys give some answers.
Telling people that are gone.
Yeah. So what's your advice for someone who might move out of the country in the near future for better career opportunities and does not want to commit to mortgage payments?
Yeah, I mean,
buy it anyway.
Yeah. So really, I get asked this question quite a bit. And a lot of the times when people are shifting overseas for their OE, and you don't really know how long you're going to be gone for, you come back eventually. And even if you don't, doesn't mean it's not still a good idea to have an asset here. So my advice for you, if you are thinking about buying property, but you don't want it to commit to mortgage payments overseas, you need to be looking at a high yielding property to make sure that the cash flows are as neutral as possible. And again, to speak to the two examples that Matt gave before, if you were to say buy a 750K townhouse in Auckland, you are going to be having to top up those rentals or kind of your weekly payments by a significantly higher amount than you would in, say, the new development you just showed.
Yeah. That's such an interesting question because I see people all the time. And when I meet with people and discuss their wealth, the quantity of wealth someone has that owns property versus doesn't is stark. So like, if you don't want to commit to a property, that's absolutely your choice and you should do what's right for you. But in my experience that I see every single day, people that commit to property ownership have significantly more wealth than the people that don't.
Yeah. I'm going to be less on the fence, buy a property.
The other bit is, so we talk about the risk of the mortgage payments, right? And the commitment. We don't talk enough about opportunity costs. So if you don't buy it and you return in 5 years' time, say that $500,000 house, how much is it going to be worth? We're talking about 5% a year over 5 years, 250 grand in capital gains. Like the amount you'll have to play catch up from going and living your best life overseas, which definitely go and do your OE, learn those skills, bring them back to New Zealand, make New Zealand better. But the opportunity cost is quite a lot. So you need to think about it. Why do you think the property prices will double over the next 10 years now that prices are so high in relation to salaries? Are you assuming salaries are irrelevant for some reason? It's a great question. People go, what's happened historically? That's not going to happen going forward. What do you guys think?
Well, yeah, I believe property prices will pretty much double. I think when you say house price inflation, it's say 6-7% a year. For 10 years, it ends up being like a 60-70% increase. If you want to see an example of this actually happening, look at Sydney prices today.
Exactly what I said.
The median house price is $1.6 million. Salaries are a little under 100,000. Like
they are higher than New Zealand, but
not consequentially higher. So we already have comparable markets where we can see in excess of the example you're saying won't happen happening. So don't get me wrong. I understand as property prices get higher, it seems harder to believe, but the fundamentals are still telling us it will happen. And I'm listening to the fundamentals. But it might be less. Like we might see property increase at 5% a year and it ends up being 50% more expensive.
And if we're wrong and it doesn't double, but it almost doubles, do you think it really matters? Right? Like at the end of the day, the market will continue to grow. And I'm not shooting the question down. I'm just saying that, even if we're not quite there, we will still get some pretty significant growth.
And my other concern is I just think housing will become less affordable over time. I think a high percentage of Kiwis will end up renting. So are salaries somewhat irrelevant? Somewhat. Next question. Tony Alexander said it's the best time to buy in 2022. Lol. Do you believe interest deductibility is a tax loophole and reducing uncontrolled mass migration or population growth have an impact or reducing property prices?
So many questions. Really. Okay, firstly, I don't believe interest deductibility is a loophole. No. I believe that any business owner should be able to claim their expenses and then pay tax on the difference between their expenses and their income. I think that essentially what you're doing by not allowing that, you're putting a tax on property owners, and then property owners need to pass that tax on to the purchaser or the tenant. So all you're doing is you're making rents more expensive. So I believe that interest deductibility should be should be removed and should remain removed.
Yeah.
Let's talk about 2022. I want to touch on that comment around, like, of course that was a horrible time to invest. I like the saying, the best time to plant a tree was 20 years ago. The second best time is today. I still think if you had the money in 2021, 2022, that you should have bought the house, that you shouldn't have sat on the sideline, because you think about all the times in history where people have forecasted something bad to happen. I think for every recession that's happened, it's like it's been forecasted 10 times or something along those lines. It's all about those people who bought in 2022, like we look at that graph that Matt took us through before. It all doesn't matter long term. It's about short term pain. So if you're thinking over a year, what's going to happen? You might have some pain. You think over a decade, you're going to be all right.
But that's interesting because peak of the market was November 2021. Yeah. By the end of 2022, we'd already seen a 10% collapse. We only saw a further 5% collapse from there. And then prices actually in lots of places have rallied.
Yeah.
So I actually...
So really the only difference is just interest rates were slightly higher than they are now, but actually prices were back quite significantly.
Yeah, they were significantly back.
Cool. Next question for you, Matt. Would be interested to know why you think NZ building standards are too hard or difficult to navigate.
Well, I don't think they're hard or difficult to navigate. I've always, so me personally and Williams Corporation, we've always built significantly higher than standards, right? But my comment was that the question was, what do you think's making house prices so expensive? And one of the replies I gave in my list of replies was, I believe standards should be lower. I believe that houses should be allowed to be built fundamentally cheaper than our current standards. And then the consumer should have the right to choose with their dollars. Do they want a house at this standard, this standard, this standard? Yeah. Now, for the purpose of the example, I'm not discussing engineering. I'm discussing things like your insulation and the more superficial components of the home. And it's just, remember, every single standard comes at a cost. Like, we've essentially introduced a new standard. It's called the H1 glazing standards. New Zealand windows are now the equivalent of being triple glazed. Now, do I believe that it's the right thing for the government to say to an entire country where the top is tropical, the bottom is real cold, that you essentially have to do triple glazing on everyone because we, the government, say so? Yeah. It's not the right thing, right? Like, I personally believe if someone wants to buy a house with single glazed windows, they should have that right. And if it's important to the consumer to save that cost on those windows, they should have the right to make that decision themselves as an adult. So I'm more of a free market capitalist. I believe that government should have less involvement, less regulation, and the consumer should have the right to decide what they do with their money and how they live their life.
Cool. Next question is an interesting one. So unless we are able to buy an investment property right now, it's only going to become harder and more unattainable over time.
Yeah, it is.
And that's for a number of reasons, not just house prices, not just building costs, not just competition. From my side, when I think about that, I go, man, you know when it was easy to get a loan? 5 years ago. You know, it was easier before that, 5 years before that. Finding money or getting credit to buy a house is only going to get harder and harder and harder, right? Yeah. And it's for a number of reasons. One of them being, again, government intervention. If you look at debt to income ratios, which have just come in, are already having unintended consequences. Triple CFA regulation had unintended consequences. So, getting credit to buy a house will get harder.
Well, just on that point, what would make it easier? It would become easier to purchase a home if we had mass changes in legislation and culture, increasing free market capitalism and decreasing government control on the economy. And I think the statistical chance of fundamental change happening is very slim. Yeah. So I
wouldn't bank on it.
The regulated economy we're in, it's reasonable to assume regulations are going to come more. And it's just reasonable to assume that things will become more difficult and more expensive.
Okay, gents, let me just say the questions are increasing, not decreasing. So okay, so Matthew,
let the people ask.
You touched on listing the specifications for the builds. What areas? I think you've already probably touched on that.
Yeah, look, I don't, because the problem is people grab me and sound lights, and then the next thing I'm on the news
he
saying,
said it shouldn't have glazing.
Every house should be single glazed. So just know that I fundamentally believe that there should be less regulation, allowing the free market to decide between the builder and the consumer what standard they want to have their house when we remove base engineering and base fire standards.
Yeah, cool. Matt, the next question is talking about Christchurch and earthquakes and the likelihood of an earthquake in the future. And what do you do to factor this into your investment decision making?
Yeah, no, that's a really good quality question. I think, sorry, I think actually when you look, one of the interesting places to see what is the chance of a fundamental issue happening to that investment, the best place to see that's the insurance cost.
Yeah.
Right.
Yeah.
And at the moment, Christchurch is significantly cheaper in insurance costs than Wellington.
Oh yeah.
So when you look at the weird,
my heart goes out to everyone in Petone.
Yeah. So when you look at where do these big companies with this complex modeling system and hopefully this huge academic ability to predict things of this nature, they're not essentially saying there's a fundamental chance of something happening in Christchurch. But on that note, we learned heaps from the Christchurch earthquake. Now, I can do a whole 40-minute presentation on what we learned from the Christchurch earthquakes and how we build houses differently. Long story short is we learned how houses performed in seismic events, and we made fundamental changes to how we build houses to make them more resilient to seismic events. And that's been done in our current houses and the houses we're building moving forward. And if you want to watch a video on this, there's a great video called Williams Corporation, How We Build. It has Matt Withington, my Christchurch sales manager, in it. And he does a great job of showing you how we build a house to mitigate earthquake risk.
The other bit is you buy a house anywhere.
Yeah.
There is risk.
Yeah.
There is risk in anything you do, right? And
actually, you probably don't understand what happens if there is an earthquake. So let's say there's an earthquake and the house is fundamentally written off. There is a government fund, so the EQC fund, which pays the first $300,000 for an event of that nature. Yep. Then from there, the insurance company gets involved. Now, when we do all of our builds, we get a communal insurance policy on the whole complex. And we advise the body corporate or residents association every year, what is the replacement cost of that asset? So I think it's reasonable to say all of the post-Williams Corporation houses are correctly insured with the right policy and the right ability to give those owners the same or better than what they had after a seismic event.
Cool. Next question. We've talked about property. We've talked about shares. What about starting a business as an investment?
Hey, look, if you are able to, absolutely. As a business owner for 14 years, it has been the most amazing ride I have ever been in. It has developed me emotionally, spiritually. It's where I meet people like yourselves. I've had an absolute ball and I love it. Not all people appear to be able to do it. Like, I personally think anyone can do it, but not all people appear to be able to. It is hard.
Yeah.
It is so much harder than you ever thought it would be. Everything takes longer. It's more expensive. You lose relationships. You lose time with your family. It's brutal. But if you want to go through hell and you want to come out the other side, it's worth doing.
Yep.
It is fun. I love it.
Yeah.
You know what I mean? Like, it's not always easy, but it is fun, right? Like, some days you're like, man, if I could just catch a break, it'd be great. And other days you're like, you know what? I go to work with my best mates every day. We get to change people's lives. You know, we get to make a bit of money on the side, and it's fun.
Yeah.
And if ready for this next question.
And if you're saying like return on property, return on shares, the best return you can make is on yourself and investing in yourself, but then it's on you to execute.
Okay. The person said, how do I get more information on Allen Street? If you're looking to buy one of the studios, we have 7 available. And if you want to buy one of the 1 bedrooms, we have 5 available. Now, we released that development yesterday. I already have 2 unconditionally sold, and I already have 9 under contract. I'll smack that over in a couple of months. That is cheap stock, great location, great price. Go on our website or slide into any of my DMs on any of my social media platforms.
Yeah. Good pod, fellas. I've learned a lot from CMB. Thank you very much. Make sure to subscribe. Make us the #1 business podcast in the country. Back to you, Matt. How can they book a personal meeting with you?
Just message me on one of my social media platforms. If you actually go onto my Instagram, there's a direct link to my Calendly through a link tree, and you can just book an appointment through there. So I'm very accessible to the public.
Cool. Okay. Next one. Can I work with you and Williams Corp to learn how to get a plan sorted to buy an investment property?
Yeah.
Yes, you can.
Love these questions. No, we're doing this webinar. You can't talk.
Yes.
Yeah. Next one. What is the cost of? You would have thought Ravi's planted these questions. Cost of a financial plan. Very high level, about $2,000 plus. Just
it's great value.
Yeah. Oh, honestly, it's setting you up for your future if we don't make a good return on investment. The only caveat I would give, it's a waste of money if you do nothing with it. You have to take action for a plan to work. Otherwise, it's going to stay poor. Am I better off to save more dollars, or should I start looking to buy now? There's a great question. So the question is, lads, should I buy now or should I buy later?
I'm always buy now. And just to this person, we have people all day, every day that come in slightly before they're able to afford to buy. Now, one of the beautiful things is we'll sit down with you, and it's the same thing I assume you do in a financial plan. We'll assess where you are now. We'll assess where you can be in a year. And then we can do amazing things because a lot of these houses aren't built.
Yeah.
So let's say you need 10% or 20% and you have 10% now, you need another 10%. We can put you on a payment plan for the other 10% while we build the houses. There's all sorts of things we can do to get you there. And then you're in a forced savings plan. You've made a decision. You've locked in the current prices. If it goes up in value, you're benefiting from that. And you've got that plan in place, which is what you guys are talking about, committing to a plan.
Yeah. Mike, I'd just like you to quickly touch on all the myths around deposit requirements for a property. A lot of people think I need 20% to have to buy a place.
So you can buy a house in New Zealand with as little as 5% deposit. You've got to really thread some hoops to get through a 5% deposit loan, but that is the minimum amount that you can use to buy. It is very common for, I would say, customers to be buying with a 10% deposit these days, as opposed to something like a 20% deposit. Unfortunately, where the market is priced, it is a little bit unattainable. So, most common for first-time buyers, 10% deposit. You can buy an investment property with 10% deposit.
We can, just to throw a whole spanner in the works, we can go as little as zero because we have Own with William, which is a whole nother podcast. Long story short, we have an equity sharing company where we can actually front the deposit for you to purchase. So if you want to purchase, you have an income, but you don't have the deposit, it is worth inquiring about that scheme.
Cool.
But that's a whole other
And Ravi's just told me Alan Street is in the chat in terms of all the details, and Matt's links are in the chat as well. Good to have a Ravi in your life, my guy. I don't have much deposit. Is there any way I could buy a house now? Can William help me? Yeah. The big thing with a lot of this stuff is people make assumptions around, I can't buy now. If you talk to a professional, you're going to work it out really quick. And if you can't do it now, they'll tell you what you need to do to be able to buy.
It takes us about 15 minutes on a call to work out how much deposit you have in your affordability.
Yeah.
It's super quick.
Mike, the next question is a really good one for you because this is probably around the lending structure.
Yeah.
Have you seen people lose their main house when an investment property goes wrong?
No, I haven't.
Yeah, I've never seen it either.
Yeah. So I'm not saying it hasn't happened, but I have never seen customers, and I've been a banker and a mortgage broker for quite some time now. It's the Botox, which makes me look young. But like, to be honest, because you can liquidate that asset, the investment property, and then come back to core and focus on paying your mortgage. Yeah, it's actually pretty difficult to lose the main property. And, this might be different. Have I seen people swinging for the fence? And, that goes wrong. And yes, they do lose the house. I've absolutely seen that. But to Matt's point earlier in the presentation, if you're buying an investment property or you're buying some shares, you can't actually do too much damage. Yeah. And like, let's say you lost 50 grand, right? Let's say you went backwards 50 grand because the market came back and you couldn't afford the repo or something like that, or you couldn't tenant it. Yep. You lost 50 grand. It is very unlikely that we will lose your main house as well.
But most of the time they haven't lost the 50 grand. They might have just lost it on paper.
Yeah.
And it's not real. And what I'll mostly do with my customers, very rarely do I put someone in a more expensive asset. Like I have assets that are expensive, but most customers, I'll sit down with them. They have horsepower to buy up to 700,000.
Yeah.
I'll sell them a $480,000 asset.
Yeah.
Right. Because I want it to be easy.
Yeah.
I want it to be obtainable. I want them to enjoy it.
Yeah.
I want them to walk out of that and go,
that. I made a good decision.
And then 2 years later, that customer rolls back in because you've done what's right by them.
Yeah.
You put them in another asset slightly under what they can afford. And it creates this lovely experience with property. Most of the people that have had a bad experience is because they purchased something at the upper end of their serviceability limit.
Or someone said to them, you need to do 5 straight away. You can do 5 straight away. And I know this real interesting lending trick where I can get you 5 straight away. And they do it. And we actually saw a lot of that during the downturn. It was people who had over leveraged and got like 2, 3, 4, 5 investment properties because everyone wanted one, and then all of a sudden they're having to pare down.
I don't need them.
I'll
quite often someone will come in and say, I want 3 or 4. And I'm like, no problem. Let's start with 1 today. So.
Yeah. And a lot of those people got in trouble, plan their life off 2% interest rates. But if you're planning your life off 7% interest rates, things are only going to get easier over time.
Yeah.
Okay. Next question. What do you think about the rental properties far from where you live? Should you be buying in an area that is close to you?
Well, it depends where you live, right?
Yeah.
Let's say it doesn't matter. Because I run into it all the time. I'm a big advocate for clients making decisions just off the numbers, but a lot of clients will go, I want to be able to drive past it. I want to be able to see what's going on.
You'll drive past it once.
What are your thoughts, Matt?
I agree with you in principle. Like, people should be able to make an investment decision in a city where they don't live. People should be able to choose the property at the price point and the yield that is best suited to their current situation and make that decision. There are people that live in places that have had a magic run for property and it's forecast to continue to go well into the future. I'll quite often be with an Aucklander and I'll sit down and I'll show them the merits of Christchurch and they'll say, look, Matthew, that's amazing. Everything you've said makes sense. I've made a heap of money in Auckland. I just want to buy Auckland stuff. And I don't really argue with that. You know what I mean? I don't like, I'll give my pitch of what decision I believe they should make and why. But if they say, this is my investment criteria and the reason is logical, I don't really argue past there. There are places though where I don't believe you should purchase. There are some small towns, there's some cities that are too reliant on a single company or a single thing.
Or a dairy price.
Yeah. I mean, I get to the point where I go to some, and we certainly have some clients like this, where it does get to the point where you're like, I don't care, just buy something because I know you'll be better off buying something.
I normally don't argue with the customer past one no.
You
know what I mean? Like I'll say, I believe you should do this and why. And then if they're really fierce in their opinion, I respect that.
Cool. Matt, next question for you. The super yacht. In hindsight, was it a bad decision?
Super yacht. The super yacht.
WW is absolutely beautiful. I could do a whole podcast explaining buying that boat because it's amazing yarn. But look, I own a beautiful yacht. It's currently in charter. I may or may not sell it. There's lots of things we could do. I could have that money in cash right now. Maybe sleep a bit. No.
Yeah, you still wouldn't. You still wouldn't.
I was going to try give them.
And thank you for doing the charters because Lighthouse having their Christmas party. Looking forward to it. Okay, next one. William Corporation Capital, what is it all about? I've seen ads for 10% returns. Give us the pitch.
Right. Williams Corporation Capital, really quickly. As we grew, we had capital requirements larger than the capital we had within the company. So we essentially had all these people trying to buy houses and we didn't have enough capital to service that because as you can imagine, this is very, very capital heavy business. So what we did was we went round to investors and we said, we're going to make a company that's going to take security over all of the houses we're building. If you want to buy shares in that company, we will pay you a 10% return and the company will take security over everything we're doing. So since that idea, Williams Corporation Capital, we've raised over $280 million. We've returned about $180 million. We have just under $100 million under management. We've distributed $47.5 million in dividends. And it's been an amazing instrument. We've fundamentally changed property. It's allowed Williams Corporation to trade through very interesting economic times without ever missing a single bill payment by even a day, which is why that we built $1 billion worth of stuff, $1.2 billion, and never missed a 20th of the month payment. For those people that aren't in construction, builders in the 20th for not having a 20th. So essentially what it is it's a fund that sits next to Williams Corporation that you can become a shareholder of that proratas your security that pays you a 10% return, roughly 12-month term. And it has just under $100 million on it, and it's got a 4-year track record.
If you have an investment property which you're topping up, that's $150 a week, and you got some leftover cash, what should you do with it? Should you put it into shares? I've already got an emergency fund. Obviously, this sits within my lane. It's probably a wider piece around what else is going on. Generally, if you've got an investment property, we recommend it goes interest only to focus on paying off the debt on your own home. Investment property debt is tax deductible. The debt on your own home is not. If you have investment property and you have a large mortgage on your own home and not a very big mortgage on your investment property, reach out to the Lighthouse accounting team because there are some very interesting tax changes that have happened. But coming back to that top-up scenario, if you have the owner-occupied home, put the rest there. If you don't have any debt on your home or you're renting, the question becomes, what are you going to do next? Are you going to buy another investment property, or do you want to diversify? If you want to buy another investment property, you should be focusing on principal and interest debt, knocking that down, and then probably saving the cash, maybe using like an offset or a revolving credit facility to build that back up to then take back out to use as the next deposit. If you're not wanting to buy more property, then diversifying into shares is a really good option.
Yeah.
Cool.
Not a question, but have to say Williams Corporation's marketing is great. I see you guys everywhere.
I just have one reply. We have a saying in the office that I always say to my marketing manager, Nick. I'll walk in and I'll say, own the internet, Nick. Own the internet today. I said, I'm going to walk past, I'll walk down the street and I'll look over someone's phone and be like, can I see a Williams?
Am I there?
Yeah.
Yeah. Next question. What are your predictions for interest rates? I'm about to come off my fixed rate and undecided how long to refix for, Mike. Definitely in your territory.
Cool. So I kind of gave my prediction before everyone jumped on, which was, well, a lot of people jumped on, which is I think there'll be an official cash rate cut at the end of the year and the last cut for this year. I would also think it will be a 50 basis points cut. So quite aggressive. What am I recommending my customers do? This is not personalized financial advice.
Come on, Michael.
In general
Tell the people.
So if you think about where we are in the interest rate cycle, the reason you would fix long is if you thought interest rates were low and they were going to increase. Where we are, interest rates we know are high and we know they are going to be decreasing, right? If you just look at the long-term trends. So generally speaking, I'm advising my customers to fix for the shortest fix possible, even though the interest rate is high or the highest, because I don't think you should be on floating because the rates aren't going to come down that quick, but just basically 6 months, 6 months, 6 months, 6 months, 6 months, till I see the market start to bottom out. And then I'm going to be starting to give some more technical advice around tranches and extending things out again.
There is your personalized advice from Mike, fix for 6 months.
But book it and talk to someone.
Question for Matt. If costs of building are going up, how do you keep your costs of homes low to help consumers purchase?
Well, I was going to be a smart ass. I was going to say, well, firstly, young Matthew didn't understand. He just swallowed it. Look, one thing we have is scale. We're a very large company. Even in a slow market, we're building hundreds of houses. So essentially what we're doing is we're going through our supply chain and we're saying to each person within that supply chain, times are tough for Kiwis. We need to be as effective as possible. We need to be trying to remove price risk. We need to be fixing what we can. And we're trying to mitigate, not necessarily dropping built house price building, but trying to keep it stabilized so we can commit to building these houses for these customers at the price we expect. So we use our mass, we use our brains, and we use good quality relationships with good quality partners. I could make building cheaper. I could go to some no-name importer and buy product. But as you look at me, you can see I'm a relatively young man. I'm going to be here with you for your 10-year structural warranty. And I don't want you calling me being like, Matthew, my wall panel's falling off, the light socket's falling off, because it was brought in from a no-name importer. So we're buying from people with a balance sheet that comes at a premium. Like all of the roofs we put on our houses, we buy from Fletcher's. And that's because I look at the New Zealand construction industry and I say, if we had a mass product failure, what is statistically the highest chance company to write that check? And I see it as Fletcher's. We buy our cladding from CSR. They're 3 times the size of Fletcher's. What is the chance that they're going to be able to offer that warranty? So there's a lot of thought gone into each part of the house.
I see there are too many. This is a great question. I get this all the time. I see there are too many new builds in Auckland that are empty right now. And it is it will be more of a flood of vendors to come in the summer with bright lines reduced. Add in the massive migration to Aussie. I just don't see Auckland growing and righting itself for some time. Do you agree?
No.
Yeah, I don't. I like that he's laid out his argument. I really like that. Look, there was a technical. There's not actually an oversupply when you look at houses built, less population, but what's happened is there's an affordability issue. So because interest rates have gone up, it's now become more expensive to live in a home. So what we've now done to combat that is put more people into each home, which has made us require less houses. So if we kept our same standard of living we kept 2 years ago, we would not have an oversupply. So it's more of an affordability issue, not an oversupply. The Auckland comment's really interesting because as a Kiwi, it feels stark. It feels like all these Kiwis are going. but the data isn't showing it. Now,
Yeah.
is there a lag in that actually is happening? Maybe. I don't think it's fundamental. I think it's probably us just being a tiny bit precious about the fact we're in a difficult economic environment.
Yeah.
I think Auckland's going to bounce with a vengeance. But the timing of that, hey, it might be 9 months.
Yeah.
It might be 3 months.
Yeah.
Might be a year. But when Auckland goes with a vengeance. The prices just go ballistic. The auction rooms are full.
I want to talk about townhouses because I see that comment all the time as well. Townhouses aren't going to be there. Like when a population grows, and if you look at other countries where they're more mature, everybody wants that quarter-acre section with the white picket fence, those sort of things. You can't keep building out. People want to be central, and the only way to build housing where people can be, Mike and Matt both spoke about it, close to major amenities in the central cities near public transport, is to build up, and we need high density population. So of course townhouses are the way of the future.
Yeah, it's a great solution to the housing problem.
Cool. Okay, next question for you, Matt. What are the forces stopping a free market? Oh, let's keep this short, Matt. Is there a lobby or cartel of building materials suppliers or regulation that give preferences to monopolies or duopolies in New Zealand, or something else? Do what you want with that.
Can't comment with what happens there. But even if there is, it's not their fault because it's a business trying to protect their interest. The fault lies with the government allowing anti-competitive or anti-free market behavior. So even if there is I'm Mr. Plasterboard company and I'm trying to put legislation through the government that benefits my company that would not benefit New Zealand as a whole by creating less competition, even if I do that, that's just me looking after my interest, and that person can't be blamed. It's the government for creating anti-competitive behavior, anti-competitive legislation. So no blame on the business, blame on the government. The government does need to open up the economy. We live in a country of too many referees and not enough players. So dear people of the government, hopefully there's someone watching, just stop regulating us so much. Let us do our job.
Yeah. Cool. Let's get some good players. I like that. Next question. Are there any places in New Zealand that you advise your clients do not buy in?
You're probably a little bit different. Yeah.
I'm any city where I don't build.
Yeah. I mean, so there was a comment before around risk around employment.
Yeah.
So if you're thinking you're buying from a really either perspective, like to live in it or as an investment property, probably particularly around investment property, Invercargill is a perfect example with the smelter. So there's lots of discussion over a long period of time about what's actually going to happen to the smelter. There's about 5,000 jobs tied to that smelter, but then there's all the suppliers tied to it. And there's a lot of work that would be impacted. When you don't have density of population, that creates more risk.
Yeah. I mean, if you're going to live in the house as an owner occupier house, you buy it where you want to live, which is usually around where you work and where your family is. But as an investment property, we just tell people, like, you've got to look at two things: the capital gain and how easy is it going to be to rent out, right? And those are major city centers. Yeah. And major city centers. Exactly. So yeah, to be honest, like, if you're looking for an investment property, we'll tell you to stick to the major city centers. Yeah.
Cool. Good question for you, Matt. So you're very focused on Christchurch, Auckland, and Wellington. What's Williams Corp's view around expanding into the regions?
Okay, so I preaching from the same hymn book. So the fundamental asset I want to create is where people can live, work, and play.
Yeah.
The highest amount of capital, the highest amount of jobs, the highest amount of liquidity is going to be in the major cities. Now, we do have our prefabricated housing department, and that is going to allow us to go in and create housing in the regions. I will do regional programs once we've nailed our air home. Today, we released our first air home.
Yeah.
Cool. So we will be developing in the regions, but even if I'm sitting with you today and I have a product that I could sell you in Taupo or Arrowtown or something like that, and I would still say I believe the best place for you to put your capital is in a place of a higher population density, higher capital density, higher jobs.
100%.
So even when I have that product to sell you, which I will in the future, I still stick to my core values and the base of Williams Corporation.
Yeah, absolutely.
But that doesn't mean the regions don't need housing.
Oh, absolutely. Yeah.
Still
Absolutely.
fundamental
Yeah.
requirements.
Okay, next question. How do you guys plan to convince the youth to start investing earlier? The youth in NZ seem to lack a lot of motivation and the education.
Every generation says that about the generation before.
Yeah. And I would say that actually a lot of the youth in New Zealand are highly engaged in their finances and much more engaged than previous generations.
I'm going to get myself in trouble, but I'm not sure. There was a video I saw on social media. So this is a very, very credible source of information. But what it said was the current generation, so whatever the current young generation is, was the first generation in hundreds of years that came out with a lower average IQ than the generation before. So I haven't read the studies, I don't know, but I do think there is a reality where lack of education during COVID and these bad boys, smartphone abuse, there is something there.
Yeah.
And I don't want to be sounding old, but there is something there that we could have done better as a society.
Yeah.
But I wouldn't have a fundamental worry about motivational education, because you watch videos back in like the 30s and people say the same thing every time.
Cool. All right. Next one's for you, Matt. I am considering investing in short-term accommodation in Christchurch City, leveraging Airbnb. Do you think this is a good direction to go in?
I love it. Honestly, this is my favorite product at the moment. You can come into Williams Corporation, you can buy a studio 300 meters from the stadium, $750 million asset. You can buy them for 350,000 plus GST. It's a 10% gross return. You can pretty much leverage the whole thing and still make it cash flow positive. Lovely product, would purchase.
Imagine if interest rates were 5%, what the cash flow
which they will be.
And actually, this is one other thing. That's at $130 a night. When you look at the quality of the product and the night rate, it is super reasonable that could be 250, 270, 280 in 3 years. Customers getting a 17% return, and they think that I'm the most amazing person ever. So like I see huge potential gains in that night rate.
One of the things I will say about buying off plans at the moment is, if you're saying prices are low but interest rates are high, how do I bridge that gap? If you buy off plans and put a deposit down, you're not actually paying the mortgage for 12 months, which means that interest rates will be in a very different position in 12 months than when they are now. So it's quite an interesting way to bridge that gap.
Cool. Next question. Do you think there are implications if you buy several investment properties with different developers?
Yeah, not bad for your health. No, I wouldn't recommend that one. Sorry. I hear it's very bad.
Some sharks out there.
There are some amazing product providers out there. You should diversify. I think if you have, like, let's say you come and see me and you get an Airbnb asset in Christchurch Central City, then you might go and see Kirk Gibbons and get something in Queenstown. Or like, there are some amazing people doing some amazing stuff, and you as the consumer spending a huge amount of money, you have a duty to do some form of shopping and check that you're getting the deal. I don't want to say the best deal, because that makes that's a horrible, but just make sure you're educated before making a purchasing decision.
If you're buying a townhouse off a real estate agent and you go, who's the developer? And they spit out 3 letters and then Holdings Limited, and you Google it and you can't see anything about them, please reconsider.
Yeah, that's a really good point. Matt, next question. There's a lot of stories about you. You tell us about this one. Is it true that you couldn't sell some of the properties and had to rent them out yourself?
So we have a policy with our completed housing position. So when we have a completed house, we put it on short-term accommodation. I do have houses that I have on short-term accommodation. I wouldn't say that we couldn't sell them. I would just say that was the best decision for the company at the time. Because you can always sell
them.
It would just have to be at a price that we weren't comfortable with. So we had a point in the market where we weren't comfortable with the transaction prices or the transaction volumes. So we made the decision we wanted to be a long-term player as well, like an investor, and not dump our assets in a tough market.
And shows the strength of the company, right? There are certainly other developers where it's a fire sale. You guys go, if we don't get the price, we're not going to sell it.
We'll just wait.
Yeah. Next question. Can you explain more about why Christchurch is such an attractive option for investment properties? Is short-term or long-term rental a better option? This is an Auckland person asking the question.
Okay. Christchurch, second largest city in New Zealand, population of 400,000 people, gateway to the South Island, which has 1.2 million people. 10 years ago, we had an earthquake. We've master planned a new world-class city. We're in the middle of a $40 billion rebuild. City looks great. There's jobs, there's employment. It's lovely. Thing about Christchurch, a little bit cold. But other than that, it's a lovely,
Fresh.
lovely
Mike,
city.
fresh.
I love it. Yeah.
Drive everywhere in 10 minutes. I like short-term accommodation because in most instances you get a higher cash return. And I like the fact that you can claim the GST. And I like the fact that there's a cleaner going through it every 4 days. I just like it suits me. And it doesn't bother me that in winter I make less money, in summer I make more money. That's not consequential to me. Some people, they want to be paid each week. They want the person in the 1 year lease. They don't want any risk. So that comes down to your personal risk tolerance and your personal investment strategy. And also probably maybe how tight you are. Like if you were more tight, I'll probably recommend long term. If you don't really, if you've got the,
if you need that budgeting stability,
that
long-term rental may be a better option. But there's nothing, like you can have a mix in your portfolio, right? Like you might buy some that are long-term rentals to start off with. And then as you get a bit more equity on the balance sheet, you go, cool, I'm going to take a bit more risk here and go for some of these short-term options because again, you can see the returns on them, right? So there's having a mix in your portfolio is quite a good thing.
Cool. Next question. Matt, do you have anything that'll be ready in 12 to 18 months? I don't have enough deposit yet.
Yes. 2 options. But we're always releasing some. But yes, I've got three developments that would all meet that time frame. I even have one that's 2 years away. So absolutely, if you want something that's got a longer time horizon, we can make it happen.
The other comment would be if a lot of people say they're far away and they're not necessarily, so have a chat with Mike on the mortgage side, or owned with Williams is another option, isn't it?
Yeah.
Next question. Any advice about how to separate an emotional versus financial purchase? Financial plan is really the best answer because you're aligning your goals to the decision. It's really about focusing on the numbers, focusing on what you want to build for your life.
And you've got someone to hold you accountable.
Yeah, absolutely. Air Homes, what's it about?
Air Homes is Williams Corporation's prefabricated housing department. We have a partnership with a local manufacturer, and we have manufacturing facilities in Christchurch, New Palmerston North, and Auckland. We have 3 current options. So we have a studio, a 1-bedroom, and a 2-bedroom. Prices start from about $120,000. So we can manufacture a home in our facilities, and then we can either do the consents and put it on your site, or you can buy it directly from our yard. We are allowing the public to buy them. Being completely honest with our model, what we're looking at long term is we'll do our developments like what we said, where we can, once we master that product, we can then go and buy a block of land in Taranaki and do a block of 10 houses. So it's essentially just facilitating our property development, but they're lovely. Like when you see one, for those that haven't been through a Williams Corporation home, we're exceptional builders. You go through our product, the finish is done properly, everything's in the right place, it's nailed, and our Air Home just brings that to a whole nother level. It's really, really cool.
Cool. Ravi has put a link in the chat as well. Next one, Matt, you've talked about Christchurch a few times. Any other reasons why it's a great place to invest?
I just think you've got the coattails of the earthquake. You've got that $40 billion rebuild, which has just seemed to protect Christchurch from a very horrific market. Like when you look at the New Zealand median house price, pretty much everything goes like this and then flat. Christchurch just goes flat.
Yeah.
It's amazing graph.
Cool. These questions have started growing again, which gives me a little bit of anxiety. Are you expanding into overseas countries anytime soon, Matt?
Is that me? Oh, yes. Like we have a sales office in Singapore. We help lots of Singaporeans buy real estate. We have a support office in Philippines. I did have a development office in Australia. As the market got harder, I just wanted the capital home to finish what we're doing. I'm going to go back there next year. I'm very passionate about making Williams Corporation multinational in our income, not just multinational in how we work and operate.
Cool. Next question. Clearly, Greg Munt is listening to the webinar. He wants to know about Owned with Williams.
You reckon it's Greg?
100%.
Yeah. Okay. It says, who is Greg Munt and what is this Own with Williams thing? Own with Williams is an equity sharing company where Williams Corporation can help provide Own with Williams helps provide the deposit for you to purchase the house. Version 1 of the offering, there is no interest, no fees, and all we take is a share of the capital gains. For someone that can't buy under traditional purchase lending standards, you should seriously look at it. We've helped customers with up to a 0% deposit. We've invested up to $200,000 in one home. This money is interest free, and all we take is a percentage of the capital gain. So we only make money when you make money.
Yep.
And very last question, Michael, do Williams Corporation and Lighthouse work together to help buy a home?
Absolutely.
Cool. Okay. This has been a lot of fun. We're an hour and 50 minutes. I'm going to go get a Gatorade. I'll talk to you guys later. Thank you very much. Matt, you're a very busy man. Thank you for your time.
So,
Cool.
cheers.
Catch you next time. Bye, guys.